One man, sitting in his bedroom in Hounslow, once made the American stock market lose $1 trillion in about 5 minutes. No hedge fund, no billion-dollar firm, just a quiet bloke with a few computer screens, a broadband connection, and a skill for numbers so sharp it accidentally shook global finance. How does something like that even happen? Before you get comfortable, let me know in the comments where you're listening from and what time it is. While you're at it, please like and subscribe, but only if you're genuinely enjoying these videos. Now then, how on earth does someone turn a small London bedroom into a financial earthquake that rattled Wall Street? It's a question that still baffles economists, regulators, and honestly, most people who've ever tried to buy a stock. In 2010, the market suffered something called the flash crash, a sudden, catastrophic drop that wiped out nearly $1 trillion in minutes before bouncing right back. For years, no one knew who or what caused it. Then, in 2015, investigators knocked on a terraced house door in Hounslow. Inside, they found Navinder Singh Sarao, a soft-spoken trader with a degree from Brunel University and a habit of eating the same lunch every day. No private jet, no Rolex, just spreadsheets, algorithms, and a brain wired for patterns. He wasn't a criminal mastermind or a Wall Street insider. He was an independent trader who'd been quietly making millions from his bedroom, until one day the markets went haywire. What makes this story so strange isn't just the chaos it caused, but the man at the center of it. Sarao didn't gamble, boast, or even seem to care about the money. He drove a modest car, lived with his parents, and complained about market unfairness like most traders do over coffee. Except he may have been right, and his complaints turned into a global crisis. Tonight, we'll trace the steps that led to that extraordinary moment, how a small-time trader learned to read the hidden patterns of high-frequency trading, how the world's most sophisticated financial system failed to stop one man's orders from tipping it over the edge, and what it all says about the fragile, automated machinery that underpins modern money. By the end, you'll see how this wasn't a story about one rogue genius, but about a system built so fast, so complex, that even an honest mistake, or a slightly mischievous one, could make the floor vanish beneath the world economy. It's a story of intelligence, isolation, and unintended chaos. And it all began in a quiet London suburb. The question that lingers after hearing about a one-man market crash is simple. How? How could someone outside the financial elite cause chaos that even the smartest algorithms and most powerful institutions failed to prevent? It's like discovering your neighbor's Wi-Fi password somehow controls the Bank of England, only less convenient for everyone involved. To understand it, we need to know who Navinder Singh Sarao was before the headlines. His story begins not with greed or glamour, but with a love of numbers. From an early age, he was good with patterns, numbers that lined up neatly, prices that made sense, systems that obeyed rules. While most people find spreadsheets boring, he found them relaxing. His journey from Hounslow to the heart of the global markets wasn't one of privilege or luck. He didn't work at Goldman Sachs, didn't wear designer suits, and definitely didn't have an office with a skyline view. He studied economics at Brunel University, joined a small trading firm, and learned to spot price changes the way chess players spot openings. His world was data, repetition, and logic. Sarao's edge wasn't inside information, it was attention. He could focus for hours, watching the flow of buy and sell orders with almost meditative patience. Where others saw chaos, he saw rhythm. And in those rhythms, he saw profit. Not huge wins, just small, consistent moves. It's a style of trading built on discipline, not drama. The irony is, that same discipline later triggered one of the most dramatic moments in modern finance. The key tension in his story isn't between good and evil, it's between individual brilliance and systemic fragility. How could a man working alone from a bedroom outthink, or at least outmaneuver, $1 trillion market infrastructure. It says less about him being superhuman and more about how automated, interconnected, and reactive the financial world had become. What Sarao did, intentionally or not, was press on a pressure point hidden deep within that system. A structure built for efficiency, but vulnerable to speed. It's like flicking a domino, not realizing it's connected to a citywide sculpture made entirely of dominoes. When things go wrong at that scale, it's rarely one person's fault, but one person can still start it. By the end of tonight's story, you'll see how one trader's actions collided with algorithms, regulators, and markets designed to move faster than human thought. You'll understand what spoofing actually is, how a moment of market madness can spread globally, and why the modern economy occasionally eats its own tail. And it all begins in a place that's about as far from Wall Street as you can imagine, Hounslow, West London. A small, semi-detached house, a young man with a maths degree, and a growing obsession with how markets move. Because to understand how he rocked the system, we first need to see the world he came from. On the afternoon of the 6th of May 2010, the stock market did something no one had ever seen before. Within minutes, nearly $1 trillion in market value evaporated. The Dow Jones dropped almost 1,000 points, only to bounce back just as suddenly. It wasn't a gradual slide or a panic. It was a flash, a blink, and it changed finance forever. Traders stared at their screens in disbelief. Shares of solid companies were selling for pennies. Some trades vanished into thin air. Others executed at prices that made no sense. For 20 minutes, the financial world looked broken. Then, just as quickly, it seemed to fix itself, leaving everyone wondering what on earth had just happened. Theories poured in. A fat finger error, someone typing an extra zero, a rogue algorithm gone mad, maybe a cyber attack, but none of them quite fit. The data showed a chain reaction, not a single cause. It was as if the market had turned on itself. Thousands of automated systems all following the same flawed logic at once. To understand why, you need to know what high-frequency trading is. It's where firms use algorithms to buy and sell stocks at lightning speed, often thousands of trades per second, trying to profit from tiny price movements. The faster your software, the more money you make. It's capitalism at 300,000 miles per second, or, if you're a cynic, gambling with better Wi-Fi. By 2010, these algorithms made up most of the trading volume in the US markets. They weren't villains, they were just efficient. But efficiency without friction means instability without warning. When prices began to fall that afternoon, the algorithms didn't pause to ask why. They just kept selling, reacting to each other, feeding a cycle that spiraled out of human control. Within minutes, major companies were worth virtually nothing on paper. Procter & Gamble briefly dropped 37%. Accenture's stock was recorded at 1 cent. Even exchange systems couldn't process the chaos fast enough to correct the errors. It was like a digital earthquake, the aftershocks visible in numbers, not rubble. When the markets finally stabilized, everyone wanted a culprit. Wall Street blamed computers. Politicians blamed Wall Street. Regulators blamed unusual trading activity. The truth was murkier. The crash wasn't caused by one event, but by the perfect alignment of automation, fear, and speed. It was a reminder that even the most advanced systems can fall apart when humans stop truly understanding them. And somewhere in that chaos, deep within a web of code and market orders, a single trader in a London suburb was playing a quiet, almost invisible role. He wasn't part of a giant bank. He didn't have a team of analysts, just a home computer, a sharp mind, and a knack for seeing patterns others missed. His name was Navinder Sarao. At university, Navinder wasn't the loud one. He wasn't trying to be. While others were debating who'd won the student elections or which pub quiz had cheaper drinks, he was quietly mastering patterns. Numbers didn't intimidate him. They fascinated him. They followed rules. They reacted predictably if you understood them deeply enough. That calm logic appealed to someone who liked order more than noise. At Brunel University, he studied economics, though what really hooked him wasn't the theory or the textbooks. It was the movement. Markets seemed alive, but mechanical at the same time. They pulsed, but not randomly. They followed incentives, pressure, and expectation. For Sarao, this wasn't chaos. It was choreography, just written in code. While others got lost in equations, he saw rhythm. What makes someone good at trading isn't luck. It's focus and the ability to make 10,000 tiny decisions without losing nerve. It's also a strange kind of confidence, a belief that you can read the room, even when that room contains millions of unseen participants. Sarao's brain worked that way naturally. He could hold vast patterns in his mind and remember sequences that most people would barely notice. During his time at Brunel, Sarao wasn't dreaming of Wall Street skyscrapers or expensive watches. He was building the foundations of an edge, understanding how humans behave under pressure. In markets, fear and greed don't just shape prices, they are the price. He learned to read that emotional flow not through people, but through numbers on a screen. Those habits, long hours, focus, a tolerance for monotony, don't make for glamorous stories, but they do make for great traders. Success in markets is rarely about big bets. It's about noticing the tiniest cracks where everyone else sees smooth surface. It's repetition, precision, and restraint. All things Navinder excelled at, often to the exclusion of everything else. While his classmates might have been planning internships in shiny city offices, Sarao's path was already veering off course. He wanted control, his own rules, his own pace, his own space. The idea of answering to some overconfident graduate in a pinstripe suit probably made his skin crawl. He wasn't built for office politics. He was built for focus. What he didn't know yet was that trading rewards that kind of mind, right up until it doesn't. The same intensity that gives you an edge can also trap you inside your own head. When you start thinking faster than the system around you, you either adapt it or you break it. And in his case, he'd eventually do both. Soon after university, he'd find a place that seemed built for him, a trading arcade where speed met solitude and skill was the only hierarchy, a place where his superpower would finally meet its test. After leaving university, Navinder found himself drawn to a trading firm in Woking called Futex. It wasn't a traditional investment bank full of shiny suits and endless meetings. Futex was something different, a trading arcade, a room filled with screens, caffeine, and competitive people all trying to outsmart the market in real time. It was the kind of place that rewarded skill, not small talk. A trading arcade worked like a gym for traders. You weren't using the company's money, you were using your own. The firm gave you the tools, training, and access to the markets, but the profits or losses were yours to carry. For some, that pressure was terrifying. For Sarao, it was freedom. No office politics, no managers breathing down his neck, just him versus the market. Futex trained its recruits with a mixture of mentorship and baptism by fire. Every day, traders would sit in front of their screens, scanning live market data, trying to spot opportunities measured in fractions of a second. They weren't investors, they were speculators, flipping positions in and out hundreds of times a day. It was fast, precise, and brutally honest. Your P and L didn't lie. This was where Sarao's superpower really stood out. While most trainees panicked under the speed and constant movement, he stayed calm. He wasn't just watching prices move, he was watching the behavior behind them. Every order, every cancellation, every flicker on the screen told a story. He was learning to read the market's body language in binary. At Futex, traders lived and breathed something called order flow. It's the heartbeat of trading, the live list of who's buying, who's selling, and how desperate they are. Sarao became obsessed with it. He learned to spot when large institutions were trying to hide their true size, when the market was bluffing, and when the timing of an order revealed hesitation. It was the financial version of poker, just played at the speed of light. The environment was tough but addictive. There was constant noise, keyboard clacks, screens flashing, and the occasional outburst when a trade went wrong. It was competitive, but also strangely communal, everyone trying to make their mark before the closing bell. Coffee consumption was less a choice and more a survival mechanism. You could measure stress levels by how often someone refilled their mug. For Sarao, this world made perfect sense. The rules were mathematical, the rewards immediate, and the system mostly fair, at least at first. He found comfort in the logic of it all. If you were smarter, faster, and disciplined, you won. But beneath that sense of fairness, something else was brewing. The markets were starting to change, and the age of human reaction was giving way to one dominated by machines. For now, though, Sarao had found his rhythm. He was no longer the quiet student in Hounslow. He was a respected trader in a room full of people chasing microseconds and margins. Soon, though, he'd decide to leave that room behind, to build his own, smaller one in the quiet of his family home. Eventually, Navinder decided to step away from the buzz of the trading arcade. He didn't leave out of arrogance or burnout. He just preferred quiet. The shouting, the competition, the endless noise. It all distracted him. So he did something most traders wouldn't dare to. He moved his entire operation into his childhood bedroom in Hounslow. Low rent, no commute, and total control. His home setup was functional, not flashy. Multiple monitors filled his desk, all showing live price data, order books, and charts. He had a powerful internet connection, a high-speed trading feed, and a few custom tools he'd built with the help of developers. There was no office manager, no HR department, and definitely no dress code. Just a man, his computer, and a relentless pursuit of precision. The instrument he traded most often was the E-mini S and P500 futures contract, a financial product tied to the US stock market. It's a favorite among professional traders because it's liquid, meaning there's always someone to buy or sell with. Each tiny movement in its price could mean profit or loss. For Sarao, those micro movements were everything. His goal wasn't to predict the future, it was to respond faster than others could react. In this environment, success came down to rhythm. He'd buy and sell hundreds of times a day, sometimes within seconds, using strategies known as scalping and arbitrage. The profits per trade were small, pennies even, but they added up quickly when repeated thousands of times. It was like fishing with a net so fine it caught opportunities others didn't even notice. To keep costs low, Sarao lived simply. His desk was crowded, his lunch repetitive, his software efficient. He didn't hire staff or expand into a business empire. He saw no need for it. The fewer moving parts, the fewer things could go wrong. His idea of risk management wasn't hiring more people. It was coding more fail-safes. There's something to admire in that, even if it's a little obsessive. This frugal, focused approach also meant that every penny of profit went straight into his account. No investors to appease, no boss to please, just the markets and the margins. In some ways, it was pure capitalism, stripped of the office culture, the jargon, and the performance reviews. A one-man economy, powered by discipline and caffeine. Sarao's independence gave him flexibility, but it also cut him off. He didn't network, didn't socialize, and barely trusted banks. His world narrowed to screens, numbers, and patterns. And when your only measure of reality is the market feed, it's easy to start thinking in loops of cause and effect that no one else can see. For Sarao, that isolation wasn't a problem. It was an advantage. He had become exactly what modern markets seem to reward: focused, efficient, and ruthlessly self-reliant. But that same isolation would also mean there was no one to question his next move. Because soon, he wasn't just reacting to markets, he was learning how to shape them. By now, global regulators were knee-deep in data, trying to make sense of millions of trades from the day of the flash crash. It looked like chaos, until someone noticed a small but strangely consistent pattern. Among the massive trading firms, one account stood out. It wasn't from New York, Chicago, or Hong Kong. It was from Hounslow, a quiet suburb near Heathrow. That account belonged to Navinder Singh Sarao. On the day the markets went haywire, he'd been trading from his childhood bedroom. No skyscraper office, no team of analysts, just a cluttered desk, a few monitors, and software he'd tweaked himself. Somehow, this one-man operation was moving orders worth hundreds of millions of dollars, enough to ripple through global markets. Investigators couldn't quite believe it. Here was a man who lived with his parents, drove an old car, and wore the same jumper most days, apparently influencing the biggest financial markets in the world. If it sounds like the plot of a Netflix film, that's probably because Hollywood has far fewer ideas than real life. Sarao's technique was known as spoofing. Imagine calling a restaurant and booking every table just to cancel all of them when the crowd shows up. You're not actually eating, you're manipulating supply and demand. In trading, spoofing means placing fake orders to create the illusion of market movement, tricking others into reacting, and then quickly cancelling before execution. Using custom-built software, Sarao automated this trick. He layered thousands of fake sell orders just above the current market price, creating the impression of heavy selling pressure. Other algorithms saw this and started selling too, driving prices down. Then, when the price dipped, he'd buy for real. A few moments later, he'd cancel the fake orders and sell at a profit. Regulators later said his spoofing contributed to the flash crash. But here's the uncomfortable truth. Spoofing wasn't new, and it wasn't rare. Dozens of traders had done similar things. Sarao was just better at it, and possibly more brazen. What made his case remarkable wasn't the technique itself, but the scale and audacity of doing it entirely alone. While others had access to entire IT departments, Sarao used off-the-shelf software he'd modified himself, with requests written in blunt, almost childlike emails to his developer. Can you make it so it only cancels the fake orders if price goes up? He wasn't a criminal mastermind in the Bond sense, more of a savant who accidentally wandered into a global economic fault line. By the time the US authorities traced the flash crash patterns back to Hounslow, Sarao had made millions, all from that tiny bedroom. To them, it looked like the digital footprint of a market manipulator. To him, it was just another day's trading, and soon that quiet suburban routine was about to collide with international law enforcement. To understand what Navinder was really doing, you first need to understand the tool he spent most of his days staring at: the order book. Imagine it as a live, constantly updating list showing every price at which someone wants to buy or sell a particular stock or futures contract. It's the heartbeat of the market, ticking and pulsing with every new order, cancellation, or trade. On one side of the order book are buyers, people or algorithms placing bids at the price they're willing to pay. On the other side are sellers, offering to sell at their chosen price. The gap between those two numbers is called the spread. Every second, thousands of new orders flow in, while others disappear. What you're looking at isn't history, it's a tug of war happening in real time. Traders like Sarao don't just watch the order book, they study it like a weather forecast. They read shifts in size, speed, and placement the way pilots read wind direction. A sudden build-up of large buy orders might suggest support below the price, while a wall of sell orders above might act as resistance. It's a constant balance between demand and supply, hope and fear. But here's the catch. Not every order is what it seems. Some traders place orders they never intend to execute, using them to nudge or mislead others. It's legal to cancel orders, but not if you're doing it deliberately to trick the market. That line between smart strategy and manipulation is where things start to blur, and where Sarao's eventual downfall began. The depth of market screen, which shows the number of buy and sell orders at each price level, was Sarao's universe. He could see patterns others missed, when genuine demand was entering, when algorithms were playing games, and when liquidity was about to vanish. His skill wasn't luck or intuition. It was thousands of hours observing how digital crowds behave. If you think of the market as a queue outside a busy restaurant, the order book shows who's waiting, where, and how long they've been there. Now imagine some of those people in the queue have no intention of eating. They're just standing there to make it look busy, hoping others join. That's how spoofing works. Fake interest to move real behavior. For a trader like Sarao, understanding the order book wasn't just about predicting prices. It was about understanding people, how they react, hesitate, and overcommit. Ironically, the more electronic the market became, the more human behavior still ruled it. And that's exactly what he learned to exploit, long before regulators caught up. By mastering this invisible language of bids and offers, Sarao became fluent in the code that drives modern finance. But the same system that rewarded his precision also held a trap. Because when you understand how to influence the crowd, you might be tempted to try. By the late 2000s, the markets were no longer just human. Algorithms had quietly taken over the floor. High-frequency trading, also referred to as HFT, wasn't science fiction. It was now the main engine of global finance. These weren't the cinematic robots of imagination. They were lines of code designed to buy and sell faster than any person could blink. The goal was simple: speed. Every millisecond saved meant getting to a trade first, which, in the right conditions, meant profit. These algorithms didn't analyze companies or study economic trends. They reacted purely to data. Prices moved, they moved faster. If old-school trading was chess, HFT was more like high-speed ping-pong played by machines that never got tired. To achieve that speed, firms started co-locating their servers right next to stock exchange computers, shaving microseconds off transmission times. They paid millions just to move their data a few feet closer. In this world, distance wasn't measured in miles. It was measured in nanoseconds. Imagine paying rent for how close your house is to the Wi-Fi router. At its best, high-frequency trading made markets more efficient. Prices adjusted instantly to new information and spreads. The gap between what buyers and sellers wanted narrowed. Liquidity, or the ease of trading, seemed endless. But at its worst, it made markets hypersensitive, prone to overreaction, and nearly impossible for regulators or humans to monitor in real time. The real problem was that these algorithms didn't think, they responded. They were designed to follow patterns without context. So if one bot started selling fast, others would see falling prices and join in, amplifying the move. It's like watching a crowd start running and assuming there's danger, even if no one knows what they're running from. Sarao saw this evolution firsthand. He wasn't anti-technology. He used it too, but he understood something most didn't. Algorithms could be predictable. They didn't have common sense, only instructions. If you knew how they read the order book, you could anticipate their reactions. And once you could predict them, you could manipulate them. In some ways, HFT democratized the playing field for people who could think like machines. But it also made the markets less human, less stable, and more fragile. Small disturbances could now ripple through billions of dollars in trades before anyone even noticed. The very systems designed for efficiency had also created new points of weakness. It was within this strange new ecosystem of hyperspeed and blind automation that Sarao found his edge. While others were being replaced by algorithms, he was quietly learning how to outsmart them. And what he would eventually do with that knowledge would change the financial world forever. At the heart of Navinder Sarao's story is a technique called spoofing. The word sounds almost childish, but in the world of high-speed trading, it's a serious offense. In plain terms, spoofing means placing orders on the market with no intention of letting them execute, pretending to buy or sell just to trick other traders into reacting. Imagine booking every table in a restaurant so it looks fully booked, even though you've no intention of eating there. Real customers see it's busy and go somewhere else. Once the crowd moves, you quietly cancel all your fake reservations. Spoofing works in a similar way. It manipulates perception to shift prices in your favor. Here's how it plays out on an exchange. A trader like Sarao places a huge number of fake sell orders at prices just above the market. These orders make it look like there's overwhelming pressure to sell, which often nudges other traders to lower their bids. When the price dips, he quickly buys at the lower level, then cancels the fake sell orders before they're matched. The trick relies on speed and volume. Algorithms scanning the market see the fake wall of orders and assume it's real demand. They react automatically, adjusting prices downward. To the machines, it's just data. They don't know intention. They only see numbers. And by the time they realize the orders have vanished, the spoofer has already made their profit. Now, it's important to say this clearly. Spoofing is illegal. Regulators classify it as market manipulation because it undermines trust in price signals. Markets are supposed to reflect genuine supply and demand. If too many people start faking orders, the whole system loses meaning. It's like playing poker when half the players have invisible cards. Still, spoofing can be hard to detect. Orders are placed and cancelled in milliseconds, often automatically. It takes forensic-level data analysis to prove intent, to show someone wasn't just changing their mind, but was deliberately trying to mislead others. For years, spoofers slipped through unnoticed, hidden among the billions of legitimate trades each day. Sarao's brilliance, and ultimately his downfall, came from understanding how fragile this balance was. He saw that markets weren't being driven purely by human decisions anymore. They were reacting to layers of algorithmic behavior, some of which were easy to anticipate. Spoofing didn't break the system. It exposed how easy it was to push it off balance. What he may not have realized, sitting at his desk in Hounslow, was just how global those ripples could become. One person manipulating a price signal in a single market might not seem like much, but when algorithms around the world are all watching that same signal, even a small disturbance can become a storm. It started like any other Thursday. Traders across the world sat at their screens, doing what they always did: buying, selling, reacting. The market had already been shaky that week, rattled by fears about European debt and political tension in Greece. But no one expected what was about to unfold: a trillion-dollar drop in just a few minutes. At 2:32 p.m. in New York, the markets began to fall sharply. The Dow Jones Industrial Average, which tracks 30 of America's biggest companies, started sliding faster than anyone could process. Prices were dropping across the board: stocks, futures, and exchange-traded funds, all moving in sync, as if a giant invisible hand had pulled a lever. Within seconds, chaos replaced rhythm. Some blue-chip companies saw their share prices collapse by over 90% before rebounding just as quickly. Traders stared at their screens in disbelief. Phones rang off the hook, algorithms froze or pulled out entirely, and nobody knew whether it was a cyber attack, a malfunction, or simply panic feeding on itself. On live television, commentators were lost for words. One minute, Procter & Gamble was worth $60 a share. The next, it was showing trades at a single cent. Exchange staff were scrambling to pause trading, but the sheer speed of the fall made intervention almost impossible. Computers were talking to computers faster than any human could react. At the Chicago Mercantile Exchange, the beating heart of the US futures market, Sarao was trading. He'd been using a custom program to place and cancel large spoof orders on the S&P 500E mini futures, the same contracts that help set the tone for global stock prices. Investigators would later claim those orders exaggerated the downward pressure, adding fuel to a market already on edge. It's important to say he didn't cause all of it. The crash was a cocktail of overreactions, automated triggers, and bad timing. But his actions were part of the recipe. His orders made the market appear heavier with sellers than it really was, nudging algorithms into a feedback loop where each one saw the other's panic as proof of danger. By 2:45 p.m., the freefall stopped as suddenly as it began. Prices snapped back within minutes, as if the market had just taken a breath. In total, nearly $1 trillion in value had vanished and reappeared in half an hour. Regulators called it the flash crash, and it instantly became a modern legend in finance, a warning of how fragile a digital system can be. For most of the world, it was a freak event. For Sarao, it was just another trading day. He carried on from his room in Hounslow, unaware that his orders were now buried in the data trail investigators would soon begin to comb through. $1 trillion mystery had begun, and the clues were pointing somewhere very unexpected. When traders talk about liquidity, they mean how easy it is to buy or sell something without changing its price too much. On a normal day, markets are like deep swimming pools. Jump in, make a splash, and the surface smooths out again almost instantly. But on May 6, 2010, that pool suddenly drained. Orders disappeared. Prices dropped into empty space. The problem wasn't that there were no buyers or sellers. There were plenty. The problem was that algorithms, designed to protect themselves, started vanishing the second things got weird. As soon as the market began falling, the computers pulled their orders to avoid risk. The result was what traders call an air pocket, where there's no one left to take the other side of a trade. Imagine trying to sell your car, only to find that every potential buyer has logged off the internet at once. Prices don't fall gradually, they collapse. For a few terrifying minutes, that's exactly what happened to one of the most sophisticated financial systems on Earth. Liquidity, which usually looks infinite, turned out to be mostly smoke and code. The flash crash exposed a hidden truth. Most of the liquidity in modern markets isn't real in the old-fashioned sense. It's conditional. It's there as long as nothing goes wrong. When volatility spikes, those same traders, especially algorithms, instantly disappear. It's like a lifeboat that sails off the second the ship starts sinking. In those critical moments, the system becomes circular. Falling prices trigger automated sell orders, which push prices down further, which triggers more selling. Each reaction confirms the next until the whole thing feeds itself. Humans watching it unfold barely had time to blink, let alone intervene. And when everyone tries to exit the same tiny door at once, the door doesn't get bigger. It breaks. Regulators later found that thousands of automated trading programs were interacting with each other at once, each reacting to the same data in microseconds. Some were cancelling and replacing orders up to 20,000 times per second. That isn't a market. It's chaos wearing a suit. In that moment, it became painfully clear that speed had replaced stability as the main feature of finance. For long-term investors, the flash crash looked like a freak accident. But for those inside the system, it revealed a design flaw. A market optimized for speed is a market optimized for fragility. The faster it moves, the less time there is to think, question, or stabilize. Efficiency had quietly traded places with safety, and few had noticed until it was too late. When liquidity vanished that day, it didn't just take prices with it. It took trust. Investors realized that the markets they relied on could evaporate without warning. And among the mountain of trade data that would later be investigated, one London bedroom trader's fingerprints stood out more than anyone expected. In the months following the flash crash, experts tried to untangle what had actually happened. Everyone agreed the markets had malfunctioned, but the why was far less clear. Some blamed faulty algorithms, others pointed to nervous investors, and a few quietly wondered whether the entire system had become too fast for its own good. Among that noise, one trader's name began to stand out: Navinder Singh Sarao. Investigators studying millions of lines of trade data noticed something unusual. A single account had repeatedly placed large sell orders, then cancelled them just before execution across thousands of price points. It wasn't illegal to cancel orders, but the scale and timing were suspicious. The pattern showed up again and again, often during periods of volatility. It looked less like coincidence and more like orchestration. The easy narrative was that Sarao caused the flash crash, a lone wolf pressing a few buttons from his bedroom, triggering global panic. It made for great headlines, a human face for a mechanical failure. But the truth, as always, was more complicated. His trades might have accelerated the fall, but they didn't create the weakness that made the fall possible. That weakness was already baked into the system. The flash crash happened because markets had become too interconnected, too automated, and too reactive. When one market sneezed, another collapsed. Algorithms didn't ask why, they just followed. In that environment, Sarao's spoofing orders were like flicking a lighter in a room full of gas. Dangerous, yes, but someone else had filled the room first. It's a mistake people make all the time in business, confusing the spark with the fire. The flash crash was a symptom of a deeper structural fragility: fragmented exchanges, algorithmic herd behavior, and regulators struggling to monitor events happening in microseconds. Sarao's trades were simply the point where those flaws collided. He exploited the system, but he didn't design it. To be fair, Sarao wasn't entirely innocent either. He understood exactly what his actions did to the order book. He used layering, placing multiple large fake orders at different prices to create an illusion of heavy selling pressure. Whether he meant to destabilize the market or just profit from its reactions is still debated, but intent didn't change the outcome. The regulators had found their man, but that also made their job easier. It's far simpler to blame one individual than to confront an industry-wide problem. Punishing Sarao allowed the system to stay the same while appearing to take action. In that sense, he became both culprit and cover story, the villain who distracted from the machine itself. By the time investigators had traced his trading patterns back to Hounslow, the story had already grown beyond him. What they were really uncovering wasn't a criminal mastermind, but a human being inside a system that rewarded speed over safety. And in the race between man and machine, it turned out that neither was fully in control. When American regulators began digging through the aftermath of the flash crash, they didn't start with suspects. They started with data. Every order, every cancellation, every trade had been recorded in the digital archives of the Chicago Mercantile Exchange. Billions of lines of code that, when stitched together, told a story no one expected to end in a quiet London suburb. The US Commodity Futures Trading Commission, CFTC, and the Department of Justice began a forensic analysis of trading activity on May 6, 2010. They weren't looking for villains, they were looking for anomalies, patterns that didn't fit. In that sea of activity, one stood out: a trader consistently placing and cancelling large orders far away from the market price. Always the same style, same timing, same fingerprint. That fingerprint belonged to Navinder Singh Sarao. Investigators could see his trades stretching back years, showing a pattern that matched the hallmarks of spoofing. His algorithms had been placing tens of millions of pounds worth of fake orders at a time, layered neatly to give the illusion of deep selling pressure. What stood out wasn't just the volume, but the precision. It was almost too consistent to be coincidence. The discovery raised eyebrows. Why would one person in the UK be trading at such scale in the US futures market? Most high-frequency firms were billion-dollar operations with entire teams of programmers and risk managers. Sarao's trades, by contrast, came from an address in Hounslow, registered under his own name. It looked amateurish on paper until they realized how profitable it had been. He wasn't running a scam in the traditional sense. He wasn't stealing money directly or hacking systems. He was manipulating perceptions, using fake orders to influence algorithms that were themselves trying to outsmart each other. It was like beating chess computers by making them believe the board was bigger than it really was, a human loophole in a machine-run system. The CFTC built its case methodically, tracking years of activity. They subpoenaed data, cross-checked timestamps, and worked with exchange engineers to replay the market second by second. Slowly, a pattern emerged that linked his trades to unusual price movements, not just during the flash crash, but in hundreds of smaller events before and after it. His strategy wasn't a one-off, it was a habit. By 2013, American authorities had a clear picture of who they were looking for. They traced the trading firm, Sarao Futures Limited, to a semi-detached house on a quiet residential street in West London. The details felt almost comedic. Millions of dollars routed through a home office next to Heathrow Airport. It wasn't exactly the image of a financial terrorist. More dad fixing the Wi-Fi, less global market disruptor. Still, the evidence was overwhelming. By 2015, the investigation would reach its conclusion, and the knock on the door would come. For years, Sarao had sat at his desk, thinking he was invisible, a small player in a vast, automated system. But the system had noticed, and now it was coming home to Hounslow. On a grey April morning in 2015, the quiet cul-de-sac in Hounslow filled with something unusual. Police cars, reporters, and neighbours craning their necks from behind curtains. The story that had started with invisible trades and complex algorithms had arrived, quite literally, at someone's doorstep. And not just any doorstep, his parents' modest semi-detached house. Navinder Singh Sarao was arrested by British police at the request of the United States Department of Justice. The charges sounded surreal in the setting: wire fraud, commodities manipulation, and one count of causing a trillion-dollar stock market crash. You can imagine the confusion on the street. This wasn't the sort of area where global finance usually came to call. Inside, the scene was calm. Sarao didn't resist or deny who he was. He admitted to trading but insisted he hadn't done anything criminal. To him, spoofing wasn't a conspiracy. It was just a technique, one used by many. The idea that his pattern of clicking and cancelling orders could lead to armed police on his parents' doorstep must have seemed absurd. Neighbours told reporters he was quiet, polite, and rarely seen. They couldn't reconcile the mild-mannered man they knew with the headlines calling him the Hound of Hounslow. Even his family seemed stunned. Their son wasn't a billionaire or a fraudster. He was a man who spent most of his time indoors, surrounded by screens and spreadsheets. The search of his home turned up what you'd expect of a serious trader: computers, hard drives, trading logs, but no evidence of luxury. No yachts, no flashy cars, no private jets hidden under a tarp in the garden. The tabloids were disappointed. For someone accused of rocking the financial world, he lived like someone who'd just passed their driving test and moved back in to save rent. From that day, Sarao's life changed completely. He was taken into custody, released on bail, and placed under strict conditions. His passport was seized, and he was confined mostly to his family home, awaiting an extradition battle that could see him sent to face trial in the United States. The irony wasn't lost on anyone. A man who'd made millions moving money across borders now couldn't leave his own street. The arrest made global news. Journalists couldn't resist the contrast. The quiet British trader accused of outsmarting Wall Street's machines. Some saw him as a genius, others as a scapegoat. But in that small Hounslow house, the reality was simpler. A man sitting in his room, surrounded by computers, waiting to find out whether he'd spend the next decade in an American prison. What happened next would become an international legal tug-of-war. The United States wanted him extradited. The United Kingdom hesitated, and as the lawyers argued over jurisdiction and justice, the world began to ask a quieter, more uncomfortable question. Had they really found the villain, or just the most convenient one? Once the headlines faded, the real battle began, not in trading pits, but in courtrooms. The United States wanted Navinder Sarao extradited to face trial on their soil, arguing that his trades on American exchanges made him accountable under American law. The United Kingdom, meanwhile, hesitated. The question wasn't just what he'd done, but where justice should live. Sarao's defense team argued that he shouldn't be sent abroad for something he did entirely from his bedroom in Hounslow. His actions, they said, were carried out from a domestic computer under British jurisdiction, with no physical presence in the United States. The Americans countered that it didn't matter where his chair was. His trades had impacted US markets, and that was enough. The extradition debate became more philosophical than legal at times. Where does the internet end and geography begin? If a keystroke in London moves billions in New York, whose laws apply? It wasn't just about Sarao anymore. It was about a global system where borders mean little and speed means everything. The courtroom felt more like a proxy debate about how the modern economy actually works. For Sarao himself, life was frozen. He was placed under strict bail conditions, wearing a tag with limits on his movement and finances. He couldn't trade, couldn't travel, and couldn't work in the profession that had defined his life. Each hearing dragged on for months as lawyers bickered over definitions while he remained largely confined to his family home. He wasn't a flight risk. He barely went outside. But the legal process treated him like one. The US prosecution painted him as a financial manipulator who'd endangered global stability. His lawyers described him as an obsessive, socially awkward man who'd exploited system loopholes without fully grasping the consequences. The truth, predictably, sat somewhere between those two extremes. In many ways, this was an impossible case to tidy up. Technology had moved faster than regulation, and Sarao had operated in that grey zone between innovation and manipulation. To him, spoofing wasn't criminal, it was clever. To regulators, it was corruption. And to courts, it was a jurisdictional nightmare. Everyone wanted to make an example of him. No one wanted to admit the system had allowed it. The hearings stretched on for years, marked by delays, appeals, and endless paperwork. Legal experts dissected everything, from extradition treaties to mental health reports, trying to determine whether he was fit to stand trial abroad. Meanwhile, the US government kept up pressure, confident they'd get their man eventually. By 2016, the decision was made. The courts approved his extradition, but under one important caveat. They wanted assurances he wouldn't face an extreme sentence. The case had shifted from a moral argument about fairness to a negotiation about mercy. And as Sarao prepared to face an American courtroom, the question lingered. Was this justice or just good theatre for a fragile financial system? When Sarao finally faced the legal spotlight, his defense team built their argument around something few could deny. He wasn't a Wall Street shark. He was a socially awkward, intensely focused man whose entire world revolved around numbers and patterns. The prosecution painted him as a market manipulator. His lawyers described him as a misfit genius who'd misunderstood the consequences of his own precision. They didn't deny that he'd placed and cancelled large orders. The facts were all in the data. What they challenged was intent. To convict someone of fraud or manipulation, prosecutors had to prove he'd deliberately tried to deceive. But Sarao's team argued he wasn't scheming to crash markets. He was reacting to them, playing within a system already designed to reward speed over sense. His barrister described him as brilliant but eccentric, a man with an almost obsessive relationship with order and control, deeply suspicious of institutions and authority. Reports suggested he might be on the autism spectrum, which, they said, explained his discomfort with people and his deep focus on systems. He didn't lie or cheat in the traditional sense. He engineered strategies like puzzles, solving problems no one else even saw. Sarao himself didn't seem to care much for the grand courtroom spectacle. He spoke softly, avoided eye contact, and often appeared baffled by the scale of what was happening. The idea that American prosecutors were calling him responsible for a trillion-dollar event seemed absurd to him. He didn't see himself as powerful, just as someone who'd mastered a niche skill in an unfair system. His legal team argued that his behavior wasn't malicious, but mechanical. He had built his own trading tools, often coding adjustments himself or hiring small-time developers to tweak them. His spoofing algorithm was more a custom interface for managing orders quickly than a sophisticated weapon. If it had effects he hadn't foreseen, that was the system's fault as much as his. The court heard how he'd refused to move his money offshore or create shell companies, unlike actual fraudsters. Most of his profits sat untouched in regular accounts. For all his supposed cunning, he hadn't even tried to hide. That, the defense claimed, was because he didn't think he was doing anything wrong. He believed he was simply competing and winning. Behind the legal jargon, there was something undeniably human about his case. A lone trader with extraordinary focus had collided with an industry that had outgrown its own understanding. He wasn't part of the machine. He was an outsider peering in, exploiting the gaps that the professionals had left open. That didn't make him innocent, but it did make him complicated. As the hearings went on, a picture emerged that was hard to categorize. Was he a criminal or just a savant caught in the gears of modern finance? The truth didn't fit neatly into a headline. And for the justice system, like the markets he'd outsmarted, that ambiguity was the hardest thing to process. For all the sympathy his defense tried to build, the prosecution's case was brutally straightforward. They argued that Sarao knew exactly what he was doing. He hadn't stumbled into market manipulation. He had designed it, refined it, and profited from it for years. To them, he wasn't a misunderstood outsider. He was a methodical rule breaker who'd found a weakness and exploited it without hesitation. Prosecutors presented evidence drawn from millions of individual orders. They showed that Sarao's spoofing wasn't occasional or experimental. It was systematic. Day after day, he placed massive sell orders far away from the current market price, creating the illusion of pressure. The moment the price dipped slightly, he would cancel those fake orders and scoop up contracts at the lower level, making tidy profits with mechanical precision. They called it layering. He would stack his fake orders across multiple price levels to make the market look even more imbalanced. It wasn't reckless, they said. It was calculated. They even showed emails between Sarao and software developers where he requested custom programs to automate the process. The tone of those messages was coldly practical. He wasn't joking about spoofing, he was engineering it. Investigators showed how he'd used these techniques long before and after the flash crash. Between 2009 and 2014, his trades generated millions in profits. He'd done it from the same house, using the same method, always just below the radar of regulators. The pattern was too consistent, too deliberate, to be explained away as coincidence or clever timing. The prosecution's key point was intent. Spoofing isn't about bad luck. It's about creating a false picture of demand. They said Sarao placed orders knowing full well they would never execute. His goal wasn't to trade fairly, it was to push prices his way. To them, it wasn't an innocent game of strategy. It was lying, just with software instead of words. When prosecutors presented the evidence in court, the numbers spoke louder than any speech. They could replay every flicker of his mouse, every order placed and withdrawn, second by second. It was like watching digital fingerprints in motion. The pattern was unmistakable. His orders appeared, the market moved, the orders vanished, and profits rolled in. They also challenged the idea that he didn't understand the damage. Sarao was, after all, a professional trader who had spent years studying how markets worked. He knew that large, visible orders influenced other participants, especially algorithms. He didn't just know it, he relied on it. His intelligence, in this case, became the prosecution's best evidence against him. To them, he wasn't a victim of the system. He was proof of how fragile it was. One man with focus, code, and intent had managed to nudge the global market off balance. And while the defense spoke of obsession and misunderstanding, the prosecutors offered something simpler: cause and effect, actions, consequences, and a man who finally had to face both. In the end, Navinder Sarao chose not to fight the full weight of the American justice system. After years of legal wrangling, his lawyers negotiated a deal. In 2016, he pleaded guilty to two charges, one of wire fraud and one of spoofing. It was a remarkable outcome, given the dozens of counts originally filed against him. But what happened next surprised almost everyone. Despite confessing to crimes that had shaken confidence in global markets, Sarao didn't go to prison. Instead, the judge accepted a recommendation for leniency. He was ordered to repay millions in profits, cooperate with regulators, and avoid trading. For someone facing potential decades behind bars, it was an extraordinarily light outcome. Even the prosecutors didn't seem entirely sure how to explain it. The reasoning was complex, but quietly humane. The court accepted that Sarao's mental health and neurodivergence had shaped his behavior. Reports suggested he was on the autism spectrum, with traits that made him obsessive, literal, and socially detached. The judge saw a man who'd excelled in numbers, but struggled in systems built on ambiguity and rules that weren't always logical. He was also, importantly, helpful. Sarao agreed to assist American regulators by sharing insights about market manipulation and high-frequency trading. He became an unlikely consultant, helping the same institutions that had once hunted him understand how spoofing worked. The man they had branded a threat was now teaching them how to spot others like him. His cooperation mattered. The Justice Department acknowledged that his expertise helped improve surveillance systems designed to detect fake orders. That contribution, combined with his health concerns and remorse, convinced the court that imprisonment wouldn't serve much purpose. As one official quietly admitted, he wasn't a danger to the public, just to poorly designed algorithms. Sarao was ordered to forfeit more than $12 million, a figure representing his profits from spoofing. The irony was that most of it didn't exist anymore. His accounts had been frozen for years, and the rest tied up in taxes and legal fees. He left court financially ruined, but free. In a world obsessed with punishment, he became an example of something rarer: measured justice. After his case ended, Sarao retreated from public life. He stayed in West London, living quietly, far from the noise of trading floors and headlines. No interviews, no memoirs, no attempts to reclaim fame. For a man accused of moving global markets, he seemed content to disappear entirely. It was almost poetic, in a dry British sort of way. He'd disrupted the system, then ghosted it. His story wasn't about greed or revenge. It was about how the same focus that can build brilliance can also cross lines no one thought to mark. Sarao didn't break the markets on purpose, but he revealed just how easily they could be broken, and sometimes that's punishment enough. In the years after the flash crash, regulators and exchanges scrambled to make sure it couldn't happen again. The event had exposed how fragile modern markets were, how billions of dollars could vanish in minutes because of a few lines of code and a handful of traders chasing milliseconds. The response was predictable: new rules, new systems, and a lot of very long meetings. The first big change was something called circuit breakers. These are automatic pauses in trading, designed to calm everyone down when prices move too far, too fast. Think of them like emotional support buttons for the market. If the price of a major index drops more than a set percentage within minutes, trading halts temporarily. It's not elegant, but it stops the spiral. Next came the limit up, limit down rules, which sound like bad dance instructions but are actually safety nets. They prevent individual stocks from trading too far outside their recent price range. If a company's share price suddenly collapses by 20% in a minute, the system freezes that stock until things stabilize. It's a digital version of saying, everyone take a breath. Exchanges also built what they called kill switches. These are automatic controls that cut off trading firms if their algorithms start behaving strangely or losing too much money too quickly. It's like a circuit breaker for the circuit breakers. Firms now had to build in risk controls, stop limits, alerts, and emergency shutdowns to prove they could be trusted not to blow up the market again. But technology never stops evolving, and regulation rarely keeps pace. The same high-speed environment that caused the crash also made it harder to monitor. Market surveillance systems were upgraded to detect patterns like spoofing, layering, or quote stuffing. Yet spoofers kept adapting, rewriting their code to look just different enough to slip through the filters. It was a never-ending game of digital cat and mouse. Sarao's case became a teaching moment in those regulatory circles. Officials used his trading data as an example of what not to miss. The irony was that many of the safeguards introduced after the crash might have caught him if they'd existed earlier. His story became part of compliance training, a bedtime story for junior traders about how not to get famous. Despite all the changes, critics argued that the core problem remained. Markets had become too fast, too fragmented, and too dependent on algorithms. The safeguards were like speed bumps on a motorway still filled with race cars. They could slow things down briefly, but not change the underlying obsession with speed and profit. In theory, the system became safer. In practice, it became more complicated. Regulators caught spoofers more easily, but volatility never truly disappeared. The truth was simple: you can patch a system, but you can't patch human behavior, especially when the humans keep building machines that act faster than they can think. Today, more than 70% of all trading in major markets is done by algorithms. Computer programs buying and selling at speeds that make human reaction times look prehistoric. These aren't men in suits shouting across a trading floor. They're lines of code competing for microseconds. The stock market has become less like a crowd and more like a server farm with a caffeine addiction. Algorithms don't think in terms of news or emotion. They act on data, price movements, volume changes, and hidden signals in the market. The goal isn't to understand why something happens, just to react to it before anyone else does. It's a world where being early by 0.0001 seconds can be worth millions. In that sense, high-frequency trading is capitalism's version of Formula One. But there's a strange irony in that speed. The faster markets move, the less time there is to think. Algorithms interact with other algorithms in endless loops, reacting to signals that may themselves be fake or misleading. It's not uncommon for two trading systems to spend hours fighting over fractions of a penny. Tiny wars fought billions of times a day that no human ever sees. To make it work, traders pay fortunes for access to faster data connections. Some even build offices closer to exchange servers, shaving microseconds off transmission time. Others use microwave towers or lasers to send signals through the air because fiber optic cables are too slow. The race to zero delay has become so intense it borders on absurd. All this to trade faster than everyone else. The problem is that speed amplifies everything. When a market moves in a healthy way, algorithms make it smoother. But when it panics, they magnify the chaos. A tiny glitch, a mistyped order, a missing comma in code can ripple through the system in seconds, wiping out billions before anyone notices. Technology solved the problem of inefficiency, but in the process, it created fragility. Humans still oversee these systems, but oversee might be too generous. Most of the time, they're spectators. When something goes wrong, the first move is usually to switch the machines off and hope for the best. It's like piloting a plane that can fly itself beautifully, until it suddenly can't, and you realize you've forgotten how to fly. For regulators and investors, that's the uncomfortable truth. We've built a market that humans no longer fully understand. It's too fast, too vast, and too interconnected. When everything's stable, it's efficient. When anything breaks, it's terrifying. And in that gap between brilliance and disaster, fortunes are made, and occasionally lost from a bedroom in Hounslow. The machines didn't replace human emotion. They just removed the pauses that used to slow it down. Fear, greed, and overreaction still exist. They just travel faster now. The market is still human at its core. It just speaks a different language, one built from numbers, logic, and a strange kind of madness we call efficiency. In the years following the flash crash, markets didn't slow down. They sped up. High-frequency trading became even faster, with firms investing millions just to shave microseconds off transaction times. Fiber optic cables were replaced by microwave links, and algorithms began learning from one another. The system became smarter, but also more opaque. No one could quite say who was really in control anymore. That's the strange thing about automation. It doesn't remove human error, it just hides it behind code. Every algorithm has a logic written by someone, somewhere, but when hundreds of them collide, the result can look less like rational economics and more like chaos disguised as efficiency. And when things go wrong, no one steps forward to claim responsibility. Sarao's case forced regulators to confront this awkward reality. He wasn't a Wall Street executive, but his actions mirrored the same exploitative instincts the system rewarded at scale. Big firms wrote algorithms to manipulate micro-movements in prices. He simply did the same thing from a spare room. In many ways, he was a reflection, not an exception. To fix the problem, authorities introduced circuit breakers, mechanisms to pause trading during extreme volatility. It sounded reassuring, but it was like fitting a seatbelt in a car that drives itself into walls. Regulation could only slow the next crisis, not prevent it. The deeper issue was cultural. Markets had become too fast for morality to keep up. Even the traders themselves struggled to explain how their systems worked. Some algorithms adapted in real time, rewriting their own strategies based on live market data. In interviews, one regulator compared it to watching a colony of ants reorganize the city every second. It was impressive, sure, but it didn't exactly inspire confidence in human oversight. Economists began warning of flash crashes becoming the new normal, short bursts of extreme volatility triggered by feedback loops in trading software. And occasionally, that prediction came true. Mini versions of 2010's chaos popped up across currencies, commodities, even cryptocurrency. The pattern was clear. Automation had amplified not just speed, but fragility. Sarao's story was no longer an isolated incident. It was a preview of what happens when technology outpaces ethics. He wasn't the only trader bending the rules. He was just the first to make global news for it. Meanwhile, the financial world carried on as if the problem was fixed. It wasn't. It had just evolved. The markets had become a mirror of human ambition, relentless, efficient, and slightly out of control. Sarao's flash crash wasn't the end of a strange era. It was the beginning of one. And it left everyone asking the same uneasy question. If no one's driving the system anymore, what happens when it crashes again? When people think about market crashes, they imagine big, dramatic moments, ticker boards flashing red, traders shouting, and CEOs sweating into their ties. But the real danger today doesn't look like that at all. It's quiet, digital, and almost invisible. Modern financial markets can collapse faster than you can refresh a web page, and often for reasons no one can properly explain. The flash crash was supposed to be a one-off, a freak event caused by bad algorithms and bad luck. But in the years since, there have been dozens of mini flash crashes, single stocks or entire indexes briefly collapsing before bouncing back, sometimes in seconds. Each one a reminder that the same system which allows for efficiency can also crumble without warning. The problem lies in how interconnected everything is. Algorithms don't just trade stocks, they trade futures, options, exchange-traded funds, currencies, and commodities all at once. A shift in one market instantly ripples through another. It's like having every financial instrument tied together with string. Tug one end too hard, and everything twitches. It's efficient until it's terrifying. These systems are built on a concept called liquidity provision, the idea that there's always someone ready to buy or sell, but that liquidity often isn't real. It's conditional, sitting there only as long as markets behave normally. When volatility spikes, that liquidity vanishes, just as it did in 2010. It's the digital equivalent of discovering that your life jacket is inflatable, but only in good weather. High-frequency trading firms argue they make markets more stable, and to some extent they do, until they don't. Their algorithms provide liquidity most of the time, smoothing out prices and reducing gaps. But when the system wobbles, those same algorithms switch off to avoid risk. The moment they all do it together, the market falls into a black hole of its own design. What's striking is how normalized this fragility has become. Investors accept it as part of the landscape, an occasional flicker in an otherwise efficient system, but that acceptance hides something more unsettling, that the global economy is now built on platforms so fast and complex that no one can fully control them. The illusion of safety has become a business model. Every time a glitch or flash event happens, regulators promise reform. They add more layers of software to watch the software. But complexity isn't a cure for fragility. It's often the cause. Each new safeguard creates new interactions, new unintended consequences, and new ways for things to go wrong. It's a high-stakes version of whack-a-mole with billion-dollar consequences. And so the market keeps spinning, faster, louder, more automated. The players have changed, the tools have evolved, but the risk remains the same. A system that looks efficient on the surface but is quietly brittle underneath. It doesn't take a conspiracy or a villain to break it. Sometimes, all it takes is a single misclick, or a trader in a small room in Hounslow. If the flash crash revealed anything, it was that the people tasked with protecting markets were running behind the people building them. Regulators, those supposedly steering the ship, were discovering that the vessel had already been automated, and the new captain was a machine that didn't take orders, didn't sleep, and didn't have much respect for authority. The difficulty lies in speed and scale. Regulators like the SEC or the FCA were built for an age of paperwork and phone calls, not algorithms making millions of decisions a second. Monitoring high-frequency trading is like trying to catch raindrops with a spoon. You might get a few, but you'll never keep up with the storm. The tools they needed didn't exist until after the problems appeared. After the flash crash, watchdogs around the world promised reform. The CFTC in America launched investigations into spoofing and market manipulation, while Europe brought in the MiFID II framework to tighten oversight. These rules demanded more transparency from trading firms and required algorithms to be tested and logged. On paper, it looked like progress. In practice, it looked like bureaucracy chasing code. The challenge is that regulators can't innovate as fast as traders. When a rule is written, the market adapts to it within days. Algorithms are reprogrammed, strategies evolve, and new loopholes appear. It's not law enforcement. It's a permanent game of chess against opponents who can move 10 times faster and have better computers. Regulators are playing defense with dial-up internet. Then there's the political pressure. Governments want thriving financial markets, not over-regulated ones that scare away investment. So regulators walk a tightrope. Be too strict and risk slowing innovation. Be too lenient and risk another crash. It's like trying to discipline a teenager who also happens to pay all your bills. Everyone knows it's fragile, but no one wants to interrupt the profits. To their credit, some regulators have modernized. They've hired data scientists, built real-time monitoring systems, and even used AI to detect suspicious patterns. But there's a limit to what oversight can do when the system itself is built on complexity. The more they try to watch everything, the more there is to watch. Transparency, ironically, has created more noise than clarity. Sarao's case became a symbol of that tension. It showed that one individual could still slip through layers of regulation designed for an industry of giants. If regulators missed him, what else were they missing? His prosecution was less about punishing a person and more about proving the system still worked. In truth, it was a rare moment where they'd actually found someone to blame. And that's the heart of the dilemma. Markets now move too fast for certainty. Regulators can react but rarely prevent. They can study patterns but not always explain them. In an age where data has replaced instinct, the rulebook feels permanently outdated. They're not fighting fraud, they're fighting evolution, one line of code at a time. The flash crash wasn't caused by evil machines or rogue code. It was caused by human design. Every algorithm, every trading platform, every market rule came from human ambition, and ambition doesn't always make good engineering decisions. The system wasn't built to fail, but it was built too fast, too greedily, and with too much faith that humans could control what they didn't fully understand. At the heart of every digital system sits human bias. Algorithms are written by people who believe they're rational, even though they're not. They optimize for profit, not safety. They assume tomorrow will look like today. They measure risk in spreadsheets, forgetting that spreadsheets can't panic. It's the same psychology that fuels every financial bubble, just disguised as code. Traders often talk about removing emotion from markets, as if that's a virtue. But emotion isn't the enemy. It's part of what makes humans cautious. Machines don't get scared, they just execute. When prices fall, they fall faster, because no one feels pain. It's efficient, yes, but it's also dangerous. Fear slows people down. Algorithms never hesitate, and that's precisely the problem. Even when technology works perfectly, the incentives around it rarely do. The market rewards short-term wins, not long-term safety. Firms are paid to innovate, not to question the risks of their innovation. No one gets a bonus for preventing a crash that didn't happen, and so complexity builds quietly, layer upon layer, until something small knocks the whole structure sideways. There's a saying in tech, garbage in, garbage out. In finance, it's more like greed in, chaos out. Algorithms don't invent bad behavior, they just magnify it. Sarao didn't create spoofing, he just showed how easy it was to exploit a system designed to reward speed over sense. The weakness wasn't him, it was the mindset that built the playground he thrived in. The irony is that every attempt to fix the system adds more code, more automation, more dependence on tools people barely understand. We build safety features that require more algorithms, then add algorithms to watch those algorithms. It's a house of mirrors with no off switch. Everyone assumes someone else is watching, and when something breaks, it's suddenly everyone's problem. There's something deeply human about that mistake. We keep trusting our creations to be better than us, faster, smarter, more objective. But we forget they inherit our flaws, just written in a language we can't read. The more we automate, the more we outsource responsibility. And eventually, accountability becomes as elusive as the source of a flash crash itself. Sarao's story might sound like an anomaly, but it's not. It's a mirror held up to the entire system. It shows what happens when innovation runs ahead of reflection. when we mistake cleverness for control, and when the humans who build the machines forget that the biggest risk in any equation is still them. Navinder Sarao's story left the financial world with an uncomfortable question. How much power does one person really have? In a system supposedly too complex for any individual to influence, a single trader sitting in his bedroom managed to shake global markets. It wasn't intentional, but it proved something few wanted to admit. The system wasn't as stable as it looked. His case became a kind of legend in financial circles, retold with equal parts disbelief and admiration. Some saw him as a villain who exploited the system's weaknesses. Others viewed him as a modern-day Robin Hood, a scrappy outsider who outsmarted billion-dollar trading firms from a suburban home. The truth, of course, sat somewhere awkwardly in between. Too clever for sympathy, too human for condemnation. To traders, Sarao was a symbol of both fear and fascination. Fear, because he exposed how easily their high-tech ecosystem could be gamed. Fascination, because he'd done it with nothing more than skill, nerve, and an internet connection. He was proof that talent could still trump resources, even in a world supposedly ruled by machines. It's just that his talent happened to be illegal. His name also became shorthand for fragility. Economists and journalists started using the Hounslow effect to describe moments when small triggers caused massive disruptions. It captured a new kind of economic truth, that global markets had become so interconnected and automated that one human's behavior could ripple across continents. It wasn't chaos theory, it was capitalism in a feedback loop. For regulators, his story became a teaching tool. Training sessions used his trades to demonstrate how spoofing worked, how to detect it, and how easily it could go unnoticed. Entire conferences were held to discuss the Sarao case. Ironically, the man once accused of breaking the system helped to rebuild its defenses, not through heroism, but through forensic study of his mistakes. For the public, his story tapped into something else, the suspicion that finance had become detached from reality. Here was a man who made millions moving numbers that didn't exist, in markets no ordinary person understood. It made people question how fair the system really was, and whether the markets were still serving the real economy or just playing with itself for profit. And for Sarao himself, his legacy was quieter. No memoirs, no interviews, no public reinvention. He seemed to vanish, leaving behind a cautionary tale for a world obsessed with speed, leverage, and cleverness. The irony was that his downfall had nothing to do with greed. It came from curiosity pushed too far, a human trait amplified by a digital age. In the end, the bedroom trader didn't just crash the stock market. He exposed the illusion that it was uncrashable. He proved that even in an age of algorithms, one individual could still matter, not through power or wealth, but through understanding how the system really worked and what happened when it stopped. Years after the flash crash, Navinder Sarao's name had faded from the headlines. The news cycle had moved on to newer crises. Crypto bubbles, meme stocks, and central banks desperately trying to keep economies awake. But for those who still remembered Hounslow, his story lingered like an unfinished sentence. It wasn't just about one man manipulating a market. It was about what the system had become. Sarao eventually walked free, avoiding a long prison sentence through cooperation with regulators. He'd helped them understand spoofing, automation, and the ways trading systems had quietly evolved to favor speed over sense. The irony, of course, was that the man accused of breaking the market was now teaching the people who ran it how it really worked. After serving his time and paying fines, Sarao disappeared from public life. He didn't spend his millions on yachts or property. In fact, he reportedly gave much of it up. Friends described him as detached from money altogether, as if, after years of gaming a system built on greed, he'd finally had enough of it. There's a strange poetic justice in that, if you can call it poetic. The real impact of his story, though, wasn't financial. It was philosophical. Regulators were forced to ask what fairness means in a world run by machines. Traders began questioning whether markets still reflect human value or just algorithmic noise. Even ordinary investors wondered if the stock market was, at its core, just an expensive computer game for the rich. And yet, nothing fundamentally changed. High-frequency trading still dominates global exchanges. Automated systems still react faster than any human can blink. The rules have been rewritten, yes, but the underlying race remains the same. Who can exploit milliseconds better than the rest? Sarao may have been punished, but the machine he exploited kept running. That's perhaps the most haunting part of his legacy. He proved that you don't need to be powerful, connected, or even particularly social to shake the foundations of finance. All you need is understanding. In a world that celebrates scale and status, one man from a modest semi in Hounslow quietly outsmarted the world's biggest banks. It's both genius and tragedy rolled into one spreadsheet. In the end, Navinder Sarao became a symbol of unintended consequence, a reminder that when you automate a system faster than you can regulate it, the first real crash is only ever a matter of time. His story was never about rebellion or greed. It was about imbalance, a digital reflection of how fragile global markets really are. Tonight, as we near the end of this strange journey from suburban bedroom to global crisis, one question lingers quietly. If a single person can bring down the system by accident, what might happen when someone does it on purpose? When people first heard that a man in Hounslow had helped trigger one of the biggest market crashes in history, it sounded like a joke. But underneath the absurdity sat something serious, a truth about how fragile modern systems are and how quickly stability can become illusion. The markets didn't collapse because of evil. They collapsed because of belief. Belief that computers were neutral. Belief that data meant control. Belief that innovation would always outsmart risk. It's a comforting story, especially in finance, a world that rewards confidence above caution. But the flash crash broke that story apart. It reminded everyone that the system we trust with our money, our pensions, and our economies is only as strong as the humans who built it. Navinder Sarao wasn't a financial mastermind or a cinematic villain. He was just a person who understood how things actually worked, how a system driven by speed could be quietly shaped by those who understood its rhythm. In another timeline, that same intuition might have made him a risk manager or a market reformer. In this one, it made him the scapegoat of an entire era. What his story really exposes is how progress often outpaces reflection. We build systems that can trade billions in milliseconds, but struggle to explain what went wrong afterward. The lesson isn't about one man breaking the market. It's about how easily the market breaks itself when no one stops to ask whether it should. It's also a reminder that cleverness isn't the same as wisdom. Finance is full of people who think they've outsmarted the game, when really they've just changed the rules to make the illusion of control last a bit longer. Sarao didn't destroy that illusion. He just showed the rest of us where the cracks already were. Since then, technology has only moved faster. AI now writes the algorithms, not humans. The same markets that once blamed a single trader now rely on systems no one fully understands. The irony is hard to miss. The world punished one man for exploiting complexity, then built even more of it. You almost have to laugh, if only to stop yourself worrying. Perhaps the real legacy of the flash crash isn't regulatory reform or better surveillance. It's humility, a quiet acceptance that no system is truly safe and that progress without pause eventually folds back on itself. It's not the most exciting moral, but in a world addicted to speed, slowing down might be the bravest thing we can do. And that brings our journey to a gentle close. If you're still with us, you're welcome to drift off with another of our sleepy deep dives. Until then, rest well and good night.